Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Friday, April 25th, 2025. Today's episode begins with our headline, "The News Confirms Recession Next Week." Don't take it from me and my crystal ball. Take a look from the Federal Reserve Bank of Atlanta, their GDP Now forecast. We have the official GDP first report coming out next Wednesday for quarter one of 2025. We know that the economy is in great shape when the GDP is 2% or higher. Lower than that says, the economy is a little weak, and if it's negative, especially if it's negative for 2 quarters back to back, that officially defines what is a recession. The Atlanta Fed uses incoming data to try to predict what the GDP will be. The chart posted on their website shows their own model adjusted for gold, and the blue chip consensus. The pure GDP Now estimate is showing negative 2%, a deeply negative number. However, they created a gold-adjusted GDP Now because we had a lot of gold coming into the United States. This sort of makes it look worse than it might otherwise be, at least according to their reports. So this green dotted line here takes gold out of the equation. And what do we have? Even when you take gold out of the equation, this is still showing below zero, negative GDP for quarter one of 2025. This is why I am predicting pretty confidently that you will see headlines on Wednesday and Thursday in the news confirming that the recession is here. Now, let's add to the blue chip consensus. These are people's opinions, especially economists working in the biggest companies in America. Their latest data is a little older. It does not include any updates past, let's say, the beginning of April. By now, it looks like it may be even at zero if we just continue this line. But I have a few things to say about this. The blue chip consensus does tend to overstate and be overconfident about positive GDP. They have a history of overestimating it, especially when going into recessions. And even their estimates, even the top range of their estimates, this blue shaded area represents the range of the people's estimates in this. Even the very, very top is not even 1.5%, and that's not even updated through the end of April. The lowest range of this is actually still below zero. This black line right here is zero, and the very middle of this is just barely above zero, around 0.5. So best case scenario, GDP is weak. And this is why I can say with pretty strong confidence that there is a very high probability of the news confirming recession next week when the real GDP number comes out on Wednesday. There will be 2 revisions after next Wednesday when they get more of the data. I don't really understand how it can take so long to get to the final number, but that's the way it works. We have the first report coming out, and then we'll have first revision and then second revision coming out later. But again, it's like best case scenario at this point. Even the most peachiest viewpoint out there is still showing a pretty weak GDP. Second agenda item, besides including the GDP report, actually, I'll say, we have huge economic data coming out next week. We have Tuesday job openings by itself can be a major, major report. If we find out that all the jobs are gone, that can be screaming that things are going downhill economically. We also have, obviously, Wednesday, like I just talked about for a long time. The GDP report, we also have ADP employment coming out, which is a good precursor to the jobs report on Friday, and PCE data telling us where inflation is. It's the Federal Reserve's favorite way to gauge inflation. They want to see this at 2%, according to what they say. And then Friday, we have the very all-important employment-unemployment report. What percentage of Americans want work and can't get it? As always, thank you for watching, subscribing, commenting, and supporting. Before we look at the charts, these are the daily reminders and my macro views. Look at the description to get a link to an explanation of all of these things in a website that I made. And no changes in the crystal ball ratings nor the Robschild portfolio here. Sorry, I kind of skipped over the community topics. So what moves did you make today? If you made any today, comment below. Love hearing what you guys are doing. And I sat on my hands. I didn't do anything today. So on to the charts. We'll start with the S&P 500. It went up by 0.74% today. I listened to a number of chartists that are good, that are better than me, and it doesn't seem like anyone agrees where we're headed here on a daily basis. Other than that, everyone pretty much agrees that the bear market isn't over. When you consider the tariff stuff going on, GDP obviously coming out weaker than at least 2%. I mean, best possible scenario at this point looks to be 1.5%. And I think it's more likely that it's going to be negative than positive. Add to this all of the daily reminders and my macro views, and I think it's going to go down. I said yesterday, you know, according to some charts, we need to kill some more bears before we can get bearish. And it seems like that's exactly what we're doing. I'm hearing more and more chartists get onto the side like, yeah, we're going to push up for, you know, maybe a few more days, maybe a week. Again, there's not a lot of belief behind this rally right now. One small thing that takes a little bit of wind out of the sails of the bulls is the advanced decline line. This square box over here is the S&P 500. The open bars are green candles going up, solid red candles. The thing we're looking at here is actually the advanced decline line, which ticked down today while the price went up. When you have this kind of divergence, it can often mean that the price got ahead of itself, and it's actually more likely to head down in the next trading day. I want to add to this that the VIX, although continuing to cool off, is still well above 20. The pricing of option contracts does not believe right now that things are okay, okie dokie. It's still saying that the market's on fire. We can also add to this the CNN Fear and Greed Index, although less fearful than the day before, we are still in fear mode. Yes, the VIX can continue to cool down. Yes, this gauge can continue its way towards neutral. But the important part is that we're pricing in and we're seeing more than enough fear to allow the market to go back down. TLT, my favorite place to be. I mentioned yesterday that if the S&P 500 were to drop, we would see a rise in TLT. This was based on a number of things, including chart patterns on the S&P 500, SOFR rates, the MOVE index, the VIX index, and I am actually still in the belief that we would have seen that today if stocks had gone down, but I am going to also say today that I'm finding it interesting that we are still in a correlated state between TLT and the S&P 500. This means that part of the fact that stocks are going up is because rates are relaxing. It almost mechanically has pressure to raise stocks, and that's what we're seeing. There are people saying that if TLT drops, that correlated state will continue, and that's what's going to drive stocks down if it occurs. I don't think so. I think this whole time when the move index was spiking and TLT was dropping and yields were going uncontrollably to the high side, a few days after Liberation Day, that's over. That's behind us. There's no longer this constant news people coming out and saying everyone's dumping treasuries and jumping the dollar. It's over. The fear of bonds is dropping here. Don't take it from me. Take it from the move index itself. This is just an absolute blow off top. This is absolutely collapsing right now. Add to this that if we get a negative GDP report, add to this if the PCE data, for example, shows a lower inflation than we expect, which is definitely a possibility. It all points to that if we see stocks going down, going into the future, this tells me this is the time where they'll become uncorrelated, TLT and the S&P 500, where we'll see stocks going down and actually bonds rising because of it. Stocks dropping and TLT dropping together was like, this is the end of the dollar. Not instead of rushing to safety into treasuries, rushing into gold and making it a skyrocket. That was very concerning. And then now that, the news is saying, oh no, Trump's not going to fire Powell. He has no intention of firing Powell. The market said, okay, all right, fine. Maybe the dollar isn't going to hyperinflate into infinity. So sorry for repeating this so much. I just think it's very important perspective to, consider that there's no longer a fear of treasury bonds, at least right now. It's gone away. We're past it. One thing that takes the wind out of my sails, though, in being bullish TLT is actually a little bit of a chart pattern in the 10-year treasury note yield. As you can see here, this is pretty clearly a bull flag. And from a pure chart pattern standpoint, it's more likely that this will break to the upside than to the downside. But that's just a chart pattern on TNX, and I think the other things going on are stronger. Next, I want to bring up HYG, junk bonds, rising into this upper range. This screams to me complacency. One thing I noticed today that I wanted to mention was a little bit of a divergence between what I see going on in HYG and the Fred's junk bond spread index, which is not continuing to drop for whatever reason. Again, HYG is a selection of bonds, not all junk bonds. So although we see HYG getting back into range where there's no worry that these junk bonds could ever get defaulted on, the junk bond spread from the Fred is still showing that we're not back into our previous range. And as this chart stands by itself, we have higher highs and higher lows still at this point. I need to see 3.42 be taken out to the downside to believe that the credit markets really don't see building risk in higher risk credit. Next, I want to bring up the SOFR rate again. I was kind of wondering, institutional money, or, what are they doing here? Are they going to be loading into one thing or another with leverage and everything? And no, today it rose a little bit, so they moved a little bit of money. I'm thinking for all the reasons I have, maybe they're going into bonds, just a touch here, but they're not loading into stocks with leverage or anything like that. We're still only 4 basis points away from the Fed floor. We haven't seen this low of a level of the financing rate, of overnight financing rate of SOFR since January 6th and 7th of 2025. So this is cash that doesn't know what to do yet. If you've been following the show, you know that I've been talking about having a large short position on SMH with SOXS, which I acquired April 14th, 2025. This was after we broke this very long-term neckline, and after retesting it, it was April 9th actually when I got that, because that was the first retest, and that's when I got the SOXS position. Now on a daily basis, we pierced the line and confirmed above it, which got me a little bit worried today until I realized how big this head and shoulders pattern is. Again, when it comes to chart patterns, I like to use them to help my bigger macro views. I'm self-admittedly not the greatest chartist in the world, but I do know that a head and shoulders top that has gone on for over a year does not deserve to be looked at on a daily candle basis. And so when we switch it to a weekly basis, the pattern becomes cleaner and a little more obvious. And for the week, although closing above the neckline, your typical chartist wants to see a close higher than that on a weekly time frame before believing that the neckline is dead. So I am diamond hands on my short still in SMH. Last chart of the day that caught my eye a bit is Dr. Copper with a PhD in economics, only because we had such a big wick today to the downside. The bears were strong and then got beaten by the bulls. Now by itself it doesn't say much as far as a chart pattern, other than there's a pretty big argument here. In order for a tail to really mean much, we would want to see a bottoming tail at the bottom of a chart or a topping tail at the top of a chart. A tail like this, to me, just signifies, more of a fight zone in copper than anything else. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.